John Woods, Chief Investment Strategist with Citi Private Bank, joins us live via Skype from Hong Kong. John, good morning. Thank you for joining us. John, you've been quoted in the past that you are excited about the new RBI governor in India. Why is that?
Well, I think he comes with an awful lot of global recognition. He brings to the table, as it were, an awful lot of international experience and understanding also, I think, of international investors, which clearly is a positive, given the vulnerability, particularly the currency has, to inflows and outflows at the moment. So I think that set of experiences is critical at this particular time. As you pointed out in your previous segment, India is experiencing quite a lot of volatility at the moment, particularly in its external accounts, and obviously the deficits are a key part of that. And my view is that anyone that can bring a profound international perspective to the obvious expertise that exists at the domestic level can only be a good thing for the country.
John, hi, morning. Just getting back to the point that you were making as to how hammered India has been in the last couple of trading sessions. And the bigger fear is what happens once, QE tapering begins. Do you think that would lead to significant outflows from India as well as other emerging market funds?
Well, it's the concern that we're all having at the moment. I don't need to remind you that between the year, for example, 2009 to 2000, in the early part of 2013, India did benefit from substantial inflows into its equity markets. Some measures I've seen go from 80 to 90 billion US dollars. Now, only a very small fraction of that has flowed out, so there is an awful lot of potential selling there in the market. And clearly that's being priced in, particularly in the FX space. The fact that the INR is in a virtual free fall at the moment is a way of the market saying, look, there's a lot of risks attached to the underlying capital flow story here in India, and we're going to price it in as quickly as we can. Now, what could be a potential sop to that, I think, will be whether or not domestic investors in the United States believe the S&P is fairly valued or rich. If that's the case, we may see a deceleration in EM-DM flows, or emerging market to developed market flows, and that may be supportive for India, but frankly for the broad Asia region. The flow has been very much one way. In recent years, it's been very much from emerging markets to developed markets, and obviously the S&P has been the principal beneficiary of that. So at the point, I guess, investors think that the market's fairly valued, and let's point out that the S&P is now trading at a P of around 15 times compared to, say, 12, 13 at the beginning of this year. So there's been a substantial amount of erosion of valuation. It could well be that we see these flows decelerate, particularly during the typical illiquid summer months that we're currently experiencing.
John, whereas India clearly is running twin deficits, both fiscal deficit and current account deficit, the fiscal situation of Japan and US is also no better. How come money managers are ignoring the rot which is there in the US balance sheet and the Japanese balance sheet? They're only focusing on emerging markets and what's gone wrong with their balance sheet.
Well, I think that's a good question, and basically it centres on the the United States intention to raise rates, and obviously the subsequent strength potentially that we can see in the US dollar. That tends to have very much of a sucking sound, or creates very much of a sucking effect, which tends to see liquidity globally heading to those higher interest rate environments, with the potential for growth as well. Let's not forget that the US has stabilized. It is now gaining traction from an economic perspective. The patient is out of, as they say, intensive care. Some support is still required, but the fact is the US is a recovering economic story, and I don't think we can describe India as a recovering economic story. Certainly there's some fiscal support going on, but I think that the general view that the US economy is on a sustainable growth path with some traction developing is really what's driving fund managers at the global level.